August 15, 1971, a Sunday night. President Nixon appears on television and changes the rules of money forever. You weren't there. Your parents might not have even noticed. But that single decision is the reason you can't afford the life your grandparents had on a single income. Here's the theft. Since 1971, American workers have doubled their productivity. We're not talking about working a little bit harder. We're talking about a complete transformation. Output per hour has skyrocketed through automation, technology, education, and efficiency gains. We produce more than twice as much value per hour worked than our grandparents did. But your wages? They flatlined. The gap between what you produce and what you earn is now the size of the Grand Canyon. And it's getting wider every single year. You've been working harder, staying late at the office, taking on side hustles, learning new skills, grinding, producing more value than any generation in history, and getting less for it. This isn't an accident. This isn't market forces. This isn't supply and demand. Someone changed the scoreboard while you were playing the game. And unless you understand what happened, you're going to keep running on that hamster wheel until you collapse. To understand the theft, you have to understand what was stolen. For most of the 20th century, America ran on a simple deal. Work hard, produce value, get paid fairly. It wasn't perfect. It wasn't utopia, but the fundamental math worked. Between 1948 and 1971, productivity and wages moved in lockstep. They were twins. If the economy grew by 3%, your paycheck grew by 3%. If productivity increased by 5%, wages increased by 5%. A rising tide lifted all boats. This wasn't charity. This wasn't benevolence from corporations. It was simple economics. When workers produced more value, Hay captured more of that value. A union factory worker in 1965 could buy a house in the suburbs, support a stay-at-home spouse, raise 3 kids, take a vacation every summer, and retire at 62 with a pension that actually paid the bills. One income, one job, one employer for 30 years. Done. That wasn't reserved for executives or the wealthy. That was standard. That was normal. That was the deal. The backbone of this system was trust. Not in politicians or banks, but in something older than governments. Gold. After World War II, the world's leaders met at Bretton Woods and agreed that the US dollar would be backed by gold at a fixed rate of $35 per ounce. Every dollar was a promise, a contract written in metal. If you didn't trust the paper, you could trade it for the gold. That wasn't theoretical. Countries actually did it. This made the dollar the world's reserve currency. It made reckless money printing nearly impossible. It made inflation a non-issue. It made lying expensive. If a government started printing too much money, diluting the currency, other countries could call their bluff and demand the gold. The tether held. The system worked. But by 1971, the tether was fraying. America had been fighting an expensive war in Vietnam while simultaneously funding massive domestic social programs. Lyndon Johnson called it guns and butter. You can have both, he promised. We can fight wars abroad and build the great society at home. We can afford it all. Except we couldn't. The treasury was hemorrhaging gold. France got suspicious first. Charles de Gaulle started demanding gold for dollars. Then Germany followed. Then Switzerland. The vault at Fort Knox was draining fast. Foreign central banks were essentially running on the bank, and the US didn't have enough gold to cover its promises. Richard Nixon had a choice. Admit bankruptcy on the world stage, raise taxes dramatically, cut spending massively, and accept the political suicide that would follow. Or change the rules. He chose the latter. On that Sunday night in August, he went on national television and told the American people and the world that the United States would no longer honor the gold standard. The dollar was now backed by nothing but a promise. A promise that could be broken. A promise that would be broken. He called it temporary. A short-term measure to stabilize the economy. 54 years later, we're still waiting for it to be reversed. It's the longest temporary measure in economic history. The moment that tether snapped, the rules of the game changed forever. The dollar became what economists call fiat currency, money by decree. Money because the government says it's money. And when you can create infinite amounts of something with a printing press or a keystroke, the value of that thing eventually trends towards zero. It's not a conspiracy. It's not political. It's just math. It's gravity. And nobody told you the equation had changed. At first, nothing seemed to change. The stock market didn't crash on Monday morning. Banks didn't fail. People went to work, bought groceries, paid their bills. Life continued. But underneath the surface, the machine had been fundamentally rewired. And rewiring a machine while it's running is how you get explosions. Without gold as the anchor, the printing press had no governor, no limiting mechanism. The Federal Reserve could now create dollars out of thin air with zero constraint. And they did. Money supply exploded. And when you flood the market with anything baseball cards, concert tickets, or dollars, the value of each individual unit drops. That's not economics. That's common sense. The 1970s became the decade of inflation. The decade where your parents remember gas lines, price controls, and checking the newspaper every week to see how much more expensive everything had gotten. Prices didn't just go up, they doubled. Your grocery bill, your rent, your gas, your electricity, everything cost more. Month after month after month. But your paycheck, it crawled. Maybe you got a 5% raise, while prices jumped 10%. You were sprinting backwards. Here's what they didn't teach you in school. Inflation isn't a natural disaster. It's not like a hurricane or an earthquake that just happens randomly. Inflation is a policy choice. It's the direct result of printing more money than the economy is producing in real goods and services. Every dollar created dilutes every dollar you already own. It's not complicated. It's theft by mathematics. While wages stagnated and the middle class got squeezed, something else was happening on the other side of the economy. The people who owned assets, real estate, stocks, businesses, gold watched their wealth multiply. Not because they worked harder, not because they got smarter, not because they deserved it more, because the rules had changed in their favor. In 1971, the median home price in America was $25,000. By 1980, it was $64,000. That's a 250% increase in less than 10 years. Your parents didn't get 250% raises in that decade. Nobody did. But if they owned a house, the net worth exploded anyway. Not because the house got better. Not because it had more bedrooms or a nicer kitchen. Because the money got worse. The asset holders won. The wage earners got crushed. By 1979, inflation hit 13%. 13% in a single year. The middle class was being destroyed in real time. Savings accounts were melting. Retirement plans were evaporating. People who had done everything right worked hard, saved money, lived within their means, watched their purchasing power collapse. That's when Paul Volcker walked into the Federal Reserve with a sledgehammer. He raised interest rates to 20%. 20%. Let that sink in. Imagine your mortgage interest rate being 20%. Imagine trying to start a business with a 20% loan. Mortgage became impossible. Small businesses collapsed overnight. Unemployment spiked to double digits. The economy went into a brutal recession. Volcker's message was clear. We'll burn down the village to save it. We'll inflict pain now to kill inflation. And it worked. Inflation died. The fever broke. But so did something else. Something that never came back. The social contract between workers and owners died in that crucible. The idea that if you worked hard and played by the rules, you'd get your fair share of the prosperity you helped create. That idea was incinerated in the fires of the Volcker recession, and it never came back. Here's the pattern that breaks people's brains. From 1971 to today, productivity has grown by 253%. Output per worker has more than doubled. We're producing more goods, more services, more value than ever before in human history. We have computers, automation, artificial intelligence, global supply chains, instantaneous communication. A single worker today produces exponentially more economic value than a worker in 1971. Wages? They've grown by 15%. Adjusted for inflation, the average worker today makes barely more than their grandfather did in 1971. Actually, depending on how you calculate it and which sector you're in, you might be making less. You're running twice as fast to stay in the same place. Actually, you're falling behind. Where did that 238% gap go? It didn't evaporate. It didn't disappear into thin air. Money is energy. Energy doesn't vanish. It just changes form. And that energy went somewhere very specific. It went to a place called capital. CEO pay in 1965 was about 20 times the average worker. That ratio had been fairly stable for decades. Today, in 2026, CEO pay is 351 times the average worker. The profits you generate at work don't stay with you anymore. They don't get distributed to the people creating the value. They flow up to executives, to shareholders, to the capital class. And they stay there. You're not failing. You didn't do anything wrong. You're not lazy. You're not stupid. You're not bad with money. The game was redesigned to extract your productivity and hand it to someone else. That's not a metaphor. That's the actual, literal mechanism of the modern economy. Let's talk about what happens when you run this experiment long enough. When you decouple money from reality, wages from productivity, and value from effort. When you tell an entire generation that they're just not working hard enough, while the math proves otherwise, you get a pressure cooker. And eventually, every pressure cooker explodes. The crashes keep coming. 2000, 2008, 2020. Each time, we're told it's a unique event, a black swan, bad luck, a once-in-a-century crisis, unforeseeable, unpredictable. But it's not. It's the exact same pattern playing out on repeat. The names change, the details shift, but the structure is identical. Here's the collapse mechanism, and once you see it, you can't unsee it. When you print unlimited money, it doesn't spread evenly through the economy like water finding its level. It flows to assets first. The Cantillon effect. The people closest to the money printer get the money first when it still has value. The wealthy buy stocks, real estate, bonds, businesses. Prices inflate. Then, slowly, the money trickles down to wages. By the time it reaches you, everything is already more expensive. You get the inflation without the asset appreciation. The middle class, who live on wages and save in dollars, watches everything get more expensive while their income stays flat. Housing becomes unaffordable. Education becomes unaffordable. Healthcare becomes unaffordable. Starting a business becomes unaffordable. Having kids becomes unaffordable. Retirement becomes unaffordable. Everything that represents upward mobility gets priced out of reach. This isn't capitalism. This is a wealth transfer system dressed up as an economy. It's extraction masquerading as markets. In 1971, the top 1% owned 23% of America's wealth. That was already a significant concentration, but it was at least somewhat balanced. Today, they own 32%. The bottom 50% of Americans, half the country owns 2% of the wealth. 2%. Half the country combined owns less than a rounding error. That's not a functioning economy. That's feudalism with smartphones. The math is simple but brutal. Every year, Inflation officially eats 3% of your purchasing power. Except the official number is a lie. Real inflation, the stuff you actually buy, like food, housing, healthcare, education, runs closer to 7%. Every year, your wage increases by maybe 2% if you're lucky, maybe 3% if you got a promotion. You're losing 4 to 5% of your purchasing power every single year, compounded. It's not loud. It's not dramatic. It's death by 1,000 cuts. Let's make this viscerally real with numbers you can feel. In the year 2000, you could buy a median house in America for $170,000. Today, that same house costs $420,000. Did the house get better? Did it suddenly have more square footage? Better construction? No, it's the same house. Often literally the same physical structure. Did your salary increase by 250%? Did you get promotions that tripled your income? No, the money got worse. The currency melted. In 1971, a single income one person working one job could buy a home, raise a family, and build a life. Today, two incomes can barely qualify for a mortgage. Two college-educated professionals working full-time can barely afford what one high school graduate could buy in 1971. This isn't laziness. This isn't avocado toast. This isn't young people not wanting to work. This is systematic, measurable mathematical extraction. And here's the part that should genuinely terrify you. We're accelerating. The pattern is speeding up. The Federal Reserve printed more money between 2020 and 2022 than in the entire previous decade. We're talking trillions with a T, multiple trillions. That money went into the economy, but you didn't get a check. The banks did. The corporations did. The asset owners did. And now we're living with the consequences. Inflation hit 9% in 2022. Your rent went up 15%. Your groceries went up 20%. Your car insurance went up 25%. Your electric bill went up. Your internet went up. Everything went up. But your paycheck? Maybe you got a 4% raise. If you were lucky. Congratulations. You just lost 5% of your purchasing power in a single year. The invisible tax just took another chunk of your life. The collapse isn't coming. It's already here. It's just happening slowly enough that you think it's your fault. You think you just need to budget better, work harder, get another side hustle, cut more expenses. But you're trying to bail out a sinking ship with a teaspoon while someone is cutting holes in the hull. If you study financial history long enough, and I mean really study it, not just read headlines, you start seeing the pattern. It emerges from the noise like a signal. And once you see it, it's everywhere. Ancient Rome, medieval Europe, Weimar Germany, modern Zimbabwe, Venezuela, Argentina. The names change. The languages change. The currencies change. But the pattern never does. It's not complicated. It's painfully, brutally predictable. Every empire, every currency, every economic system follows the exact same 5-stage cycle. Understanding this cycle is the difference between being wiped out and being positioned to thrive when the reset comes. Stage 1, complacency. The system is working. Trust is high. People save money because money actually holds value. You can put cash in a bank account and know that in 10 years, it'll still buy roughly the same amount of goods. The middle class expands. Social mobility is real. Politicians promise stability, and they actually deliver it because the incentives align. This is the golden age. The problem is, golden ages don't last. They can't, because human nature doesn't change. Stage 2, excess. The government starts spending more than it collects. Wars, social programs, infrastructure, subsidies, all individually justifiable, maybe even noble goals. But collectively, the math stops working. Tax revenue can't keep up with spending. So they face a choice. Raise taxes and face political backlash, cut spending. And face political backlash, or do something that seems politically free, print money. They always choose option 3. Always. Because the consequences are delayed and diffuse. You can't trace your grocery bill back to a specific printing decision. Stage 3. Warning. The smart money sees it first. The people who study history. The people who understand mathematics. Inflation starts creeping in, slowly at first. Asset prices begin to detach from fundamentals. A house that should cost $200,000 is suddenly $300,000, then $400,000, but wages haven't moved. Gold and hard assets start dramatically outpacing paper returns. A few voices sound the alarm. Economists write papers. Analysts issue warnings. They're ignored. Dismissed as doomers, pessimists, gold bugs. The party's too good to stop. Why ruin it with math? Stage 4. Panic. Something breaks. A major bank fails. A market crashes. A currency collapses. A sovereign default. Trust evaporates overnight. Suddenly, everyone tries to exit at the same time. The middle class, who believed in the system, who trusted the promises, who saved in the currency, watches their life savings vanish. The wealthy, who already moved their wealth into hard assets, real estate, foreign currencies, and productive businesses, buy everything on sale. Pennies on the dollar. The greatest wealth transfers in history don't happen gradually. They happen in months, weeks, sometimes days during Stage 4. Stage 5. Reset. The rules change. A new currency gets issued. A new monetary standard gets established. A new set of promises gets made. This time it's different. This time we've learned our lesson. This time we'll be responsible. And the cycle begins again. We've seen this pattern play out in Rome, with the denarius being clipped and debased. In medieval Europe, with countless currency debasements. In Weimar Germany in the 1920s. In Zimbabwe in the 2000s. In Venezuela in the 2010s. Different continents. Different centuries. Different languages. Same formula. Here's what the Capital Codex teaches. The pattern doesn't break. It repeats. Human nature is constant. Incentives are predictable. Politicians will always choose short-term political survival over long-term economic stability. Always. And right now, in 2026, we're somewhere between Stage 3 and Stage 4. The warnings are everywhere if you know where to look. So let's bring this back to your bank account. Right now, today, February 2026. What are the specific measurable warning signs that we're in the danger zone? What are the red flags that say the system is approaching a breaking point? Warning sign 1. Record debt levels. The U.S. national debt just crossed $36 trillion. We're adding $1 trillion in new debt every 100 days. Every 100 days. To put that in perspective, the entire GDP of most countries is less than $1 trillion. Interest payments on that debt now exceed the entire defense budget. We're spending more money just paying interest on old debt than we spend on the military, and we have the largest military in human history. This is mathematically unsustainable, and everyone with a calculator knows it. Warning sign 2. The disconnect. The stock market keeps hitting all-time records. The S&P is up. Corporate profits are soaring. Earnings reports beat expectations. Tech companies are worth trillions. Meanwhile, 60% of Americans are living paycheck to paycheck. Most people can't afford a $1,000 emergency expense. Credit card debt is at all-time highs. Personal savings rates are plummeting. When Wall Street is celebrating record profits and Main Street can't afford groceries, that gap is a massive warning sign. Markets don't stay disconnected from the real economy forever. Eventually, gravity wins. It always does. Warning sign 3. The velocity crisis. Money velocity is the speed at which money changes hands in an economy. It's one of the most important but least discussed metrics, and it's at historic lows. That means people are hoarding cash instead of spending it. They're saving instead of investing. They're hesitating instead of transacting. Why? Because they don't trust the future. When trust breaks down, when people lose confidence in tomorrow being better than today, the entire system seizes up. Commerce freezes. Credit markets lock. And that's when stage 4 happens. These aren't hypotheticals. These aren't theories. These are measurements, data, hard numbers. And if you know how to read them, if you understand the historical pattern, they're not whispering, they're screaming. The silent theft isn't a conspiracy theory. It's not secret cabals in smoke-filled rooms. It's a system, a mechanism, a set of incentives and structures that produce predictable outcomes. And systems follow patterns. Mathematical, historical, inexorable patterns. The pattern says that what you're experiencing right now, the squeeze, the stress, the anxiety, the feeling that you're working harder than your parents ever did and getting less, isn't ending anytime soon. Not without a reset. Not without the rules changing again. But here's the part they don't want you to know. Here's the secret that separates the people who get destroyed in resets from the people who thrive. Every reset creates winners and losers. Every currency collapse. Every market crash. Every economic transformation. And the only difference between the winners and the losers isn't luck. It's not intelligence. It's not even hard work. It's who saw it coming. The people who understood that saving in a melting currency is a losing game. The people who move their wealth into assets that can't be printed. The people who built skills that hold value regardless of what's happening to the dollar. The people who understood the pattern. And right now, the pattern is saying something very specific about what's coming next. The question isn't whether there will be another reset. The question is when, and what will you be holding when it happens? The code has been cracked.